Welcome to the What to Watch video update. This is a video that I do once a week, but I update each day in the daily video that I do, where I pick out the things that we're really watching right now. And I come up with a list of positive things, a list of negative things, and then things that are not either positive or negative necessarily, but we're just watching to see if we can get some clues as to what's happening in the market. This is being prepared from Monday, February 10th, where this week we're asking the question, will the trendless environment continue? We really haven't been going anywhere. We go up a little bit and then fall back, go up a little bit and fall back. We do see some things that are giving us some concern, but there are also some things that are giving us some encouragement as well that the market could continue to go up. First, we're going to look at the positive side of things. This just shows the intraday ratio between growth versus value for the S&P. Now we really came down. This is when DeepSeek hit everything and everything came down really in a ferocious manner there. Nvidia was down like 17%. Well, we bottomed out right near the end of January here, and we've been coming back. And this just shows that growth is outperforming value on an intraday basis, and this is encouraging. This is what we want when the market is more positive. Also, we look at the small caps. They haven't been going anywhere, just chopping along sideways. They go up a little, down a little, and then go range bound for a long time. And they fell down in Friday's session here. But if you look at the growth to value ratio here on an end of day basis, it's not really breaking to the upside, but it's not falling apart either. And we are seeing an uptrend with growth outperforming value. And we're really seeing an improvement here with the mid-cap growth of value. This did break out, but we're not really going anywhere with the indexes. And we've seen that for quite a while now. But this just gives us hope in that, okay, there is some buying going into growth stocks, and growth stocks are what you want to buy low and sell high. Also looking pretty good with the end of day growth to value ratio for the S&P. That's actually breaking out and looking fairly solid, even though we've been kind of going sideways here. Now, as I'm looking at the chart, one thing to make note of is we came up and we set a high here back in December, and then we fell back, and then we started to come back up again, and then we fell back, and then we came back up again, and then we fell back. I guess this wasn't December, this was January, but that's a little bit discouraging in that we're seeing a series of lower highs. Now, if we do go up, and we can break out above these previous levels here and break this downward trend, that would be more positive. In the meantime, it could be considered a little bit more negative if we can't get back above these series of lower highs. Now, this is holding up okay, but not great. This is a growth to value ratio looking at a growth ETF and a value ETF. They're slightly different instruments here where we are looking positive for the most part, but we're back down into the rainbow. So this isn't showing the strength that we're seeing in other places, but it's not necessarily falling apart either. Large cap growth, an ETF. We did come down in Friday's session over 1%, but we're still above the 50 period moving average. So that is still holding up for the time being. Discretionary to staples came down a little bit on Friday with the ratio between discretionary and staples, but for the most part, the ratio continues to go up. Now, this is where we've been frustrated. Now, the reason why this is on the positive side is because the green line is barely above the red line, but we're not trending right now. This is an intermediate term trend, and the ADX is the black line, and it just keeps going down, down, down. That means we're not trending. When we drop below 20, that means a trendless environment. And when we're below the moving average, that means it's still continuing to be trendless. And we can see that, first of all, the red line crossed above the green line, then the green line crossed back above the red line. Now they're coming down and they're almost equal to each other, with a slight advantage now being with the green above the red. A down day, and this could easily switch back over to negative. And we're seeing that same thing in the short term. The green line is on top, but barely, and we're still going down in the short term. And even when we look at a weekly chart, we're still positive here with the green line above the red line, even though it's been coming down. But the ADX is below 20 and declining and below its moving average. So on all the different time frames, short term, intermediate term, and here on a weekly chart, long term, we're not trending right now. The VIX is positive because we're below 20. Now, if we have a down day, the VIX goes up. If we have an up day, the VIX goes down. And we're right around the moving averages here. And we'll just be watching this. If we really start to break to the downside, the VIX will probably go up. If it goes above 20, that's when things turn more negative. As long as we're under 20, that's keeping things more positive. Smart money indicator number one, accumulation distribution. This came down in Friday's session, and we could be getting far away from the moving average, but we're above an advancing moving average here, so this is treated as positive. The Chaikin money flow, smart money indicator number two, came down in Friday's session, but the red line is still going up. Now, you could make a case that we're getting rather extreme. We could go higher than where we're at now. What we're going to be watching is this red line, whether we have an up or a down day. If the red line starts to roll over and go down, that would actually turn the context of this negative, even if it's still green, if we see these histograms continue to decline. Chaikin oscillator gave us a real extreme reading before, and it didn't necessarily mean a reversal. When we get a high reading and then reverse, a lot of times it just means we're due for some sideways or choppy action. So coming down, now this could be taken as negative because we're dropping below the moving average. But in the context of the other smart money indicators, I'm keeping it positive for now. But if we continue to decline, that would turn this more negative also. Then the vortex, another primary indicator that we look at, coming down with the green line, but the green line is still above the red line. So this is positive. And then the condition of the short-term trend is measured by 20 periods. We're kind of going flat right now, but we're still hanging out around these lines. We're not really breaking below them yet. And since we're still going up, that's more positive, but we need to get above these lines and have the lines continue to go up for the short-term trend to get more conviction. And we look at the 20 period simple and exponential moving averages. We came right down to the 20 period exponential moving average. That calculates and weights it so it's a little bit more towards recent prices. And exponential moving averages move faster than simple moving averages. But most people tend to use simple moving averages. So that's the red line here. I plot both of them because I'm constantly asked, which one is the best? And my answer is yes. So I plot both of them on this chart. So this is providing some kind of support for right now. If we continue to fall, we'll be watching the red line. If we stay above the red line, the short-term trend is still considered positive. If we drop below it, that would turn it negative. We also want to keep an eye on the intermediate term trend. The blue line and the red line, they're still going up, but we're kind of dancing right around these lines right now. And the 50 period moving averages were still above the simple and exponential version. If we continue to drop, we'll be seeing if one of these areas, especially the simple moving average, which here is in red, provides any kind of support. Then here are all the different plotted moving averages. And we're kind of messy right now. The 20 and the 50s are kind of close to each other because of the declines that we've been seeing. But we're above all of them. You could say we're right at the 20 period exponential moving average, and all the lines are still continuing to go up. So looking at it this way, we are still positive. And then this is a 20 period simple moving average of the open, high, low, and close. We came right down to the top end of this mini rainbow, which is a 20 period moving average of the high. And that's held for right now. Sometimes one of these areas in here can provide support when we come down to it. If we can bounce up off of that, that would be more positive. If we break down through the rainbow, that would be more negative. And then it would turn even more negative if the rainbow starts to roll over. Then this is actually encouraging. Even with the decline that we saw on Friday, we had a positive open. But we then ended up hitting resistance at 6,100, which is another level we're going to be watching if we get back up to that area. Well, that was enough of an upward move to generate some new point and figure buy signals inside of the S&P 500. And so this is actually positive. We're going back up after we've been chopping sideways and actually looking a little more negative. Then we also look at the NYSE bullish percent index. That went up on Friday and it's still above 50. And then we look at the NASDAQ 100 bullish percent index. This is actually getting to an extreme positive reading. So it saw some encouraging or positive things right at the open on Friday to kick this up. And then we ended up declining after that. Long term, we look at a weekly chart of the S&P, still above this trend line going back to the 1987 crash. Another broad market measure is the Wilshire 5000. Even though we declined 0.95% on Friday, we're still above the 50-day moving average and we're still in an uptrend. Total US stock ETF also still slightly above its 50-day moving average. That's positive. The financial sector still hanging out, looking pretty solid there. We want the financial sector to do well in a more positive environment. The FANG index, these are the real big stocks: Facebook, Apple, Amazon, Netflix, Google, Nvidia. Even though it declined on Friday, it's still above its 50-day moving average and still in an uptrend. I'm going to look at a ratio between stocks to bonds, and this is holding up fairly well. And when we're up getting a high reading like this, that means the market is still anticipating a soft landing. Now, the debate's going back and forth. Are we going to go into a recession? That would be a hard landing. There is evidence to say, yeah, we might go into a recession. There's also evidence like this suggesting that the market doesn't think that's going to happen. That's why we watch these charts really closely to see if there's some kind of a change coming. Then we look at a broad market measure and look at short-term bonds, still holding up okay here at the top end of the rainbow. And then we look at another broad market measure and go a little further out with bonds, still at the top end of the rainbow here. The tech sector, it's coming down. It's inside the rainbow here, but it's not necessarily falling apart. It would give us more confidence if this ratio was to go back up, but it's not really declining with a lot of conviction currently. A weekly chart of the NASDAQ 100 still above this trend line going back to 2009. That's positive. We look at a ratio between the NASDAQ 100, which is growth, and the Dow, which is considered to be more value. We're still above this red line, even though we're coming down a little bit here. We've been chopping around above the red line for the most part. Then we look at the QQQs, which is the ETF for the NASDAQ 100, and do a ratio with the IWM, which is the ETF for the small caps, still above the blue line here. And so that's looking pretty good for growth. The QQQs to 3 to 7 year bonds coming into the high end of the rainbow here, but still holding up fairly well. Then we look at the negative side. And for some reason, this I have this on the negative part here, but this is actually should be on the positive side. Oh, here we go. A little bit of a fake out there. I hit the wrong button. So now intraday, this would have been positive had we not been open on Friday, but we have to count all the days that are open. When we had the gap lower on Monday, this is after all the tariff stuff came out. We had a gap lower the week before because of the deep seek things that were coming out. But about 30 minutes after the open, we set the low for the week. And then this is about the time when Mexico came out and said, okay, we'll send 10,000 troops to the border. We'll work with you, US of A. We'll try to get this tariff thing dealt with. And that pushed this up. Now, right about that time, we were also watching the 10-year yield, and it dropped under 4.5%. Now, it went back above it later on, and I'll show you a chart later. But that just shows that if we can drop under that 4.5% level, that would give stocks still some support. And I'll cover this later on. We're still just barely under 4.5%. But then we came up, and then we ended up having a intraday strong day here. Now, take out the gap though, we can't do that. But when you look at the open to the close, that was pretty positive. And then we kind of continued with that on Tuesday, then again on Wednesday, then on Thursday, and we closed at the high on Thursday. This was really constructive looking. The reason why this is on the negative side is we had a positive open on Friday. We went right up to 6,100. This is about the time that the consumer sentiment report came out, and there's some inflation fears in that report. And this is like chicken, egg, chicken. What's coming first here? The market hit resistance, that report hits, and it just decided to go down after that. And that's why it's on the negative side, because the most recent price action was in Friday's session, and we ended up closing pretty much near the low that day. And had we closed on Thursday, we would have had an up day, but we can't count it that way. We ended up giving up the positive gains in Friday's session. And we're just having a difficult time with sentiment getting above 50. We usually ride this when it's going one way or the other, but we're real choppy, right? Like the markets are now. And even when we were getting up to 50, we would turn and come back down. This is on the negative side because we are dropping further below 50. And this had been on the positive side for a while, and there are some positive things and negative things to take from these growth to value ratio charts. But these are different vehicles that are used than what I showed previously. And we're looking okay when we look at the Qs to S&P. Discretionary, which has been pretty strong, and you look at the discretionary to staples ratio, it's doing well. But when you look at the discretionary to SPY ratio, it's been coming down lately. And when we look at large cap growth versus value, where it's looking okay on other charts, we're actually beneath the declining moving average on this chart. And so the large caps are below the moving average. The mid caps looking pretty good though. They're actually looking strong and coming down, but right at the moving average with the small cap growth to value ratio. And this is negative because we're dropping below zero based on volume. This is a 19-day advanced decline ratio. We're coming down based on price, but we're still above zero. We've already dropped below zero based on volume, and we're seeing volume having a little more intensity to the downside than what we're seeing in price right now, and that could be negative. Now, this is negative because we're going down with the 5-day and the 10-day. We're actually leveling off with the 10-day, but we're seeing more green than red when we look at the new highs minus the new lows, and that's positive. We're just not seeing it reflected in the 5-day. Let's hope that the 10-day can keep going at least flat to trying to turn back up. And that would help this chart turn more positive and then eventually see the 5-day turn back up as well. Then we look at the advancers minus decliners and look at a 10-day average here. This operates like an oscillator where we look at extreme positive or negative. When we're above zero, that's considered positive, but we have been declining. We've been chopping around the zero line. We dropped below zero on Friday, so that's turning this chart more negative. The S&P McClellan oscillator dropped below zero. That's negative, where even though it had been declining, it had been able to stay above zero. And so we're starting to roll over based on price where we've already been declining based on volume. So that's more negative there. We're also just barely dropping below zero with the NYSE McClellan oscillator, where the S&P is specific to the S&P. This is more broad market since it's across the NYSE, but that's looking a little more negative. And we're just starting to roll over. It's really hard to see here based on price, and we're pretty much flat to sideways when we look at this based on volume. That's considered to be a little bit more negative. We want both of these to go up and show some real advancements. They're not really doing that right now. And we're seeing some weakness in our advanced decline lines, coming back down to the moving average with the NYSE common stock, coming down but still above the moving average with the S&P, also with the mid caps coming down but above the moving average, where we're falling below the moving average here with the small caps. So not seeing across the board strength right now. And the Swenlin trading oscillator, we're declining based on price. Now, this could be taken as somewhat positive. We were declining based on volume, but we actually started to flatten out a little bit here and trying to turn back up. So we're getting a mixed picture right now, but for the most part, this had been declining. And the daily chart of the parabolic SAR, the dots are on top, so that is negative. But when you look at the weekly chart, we're still positive. The dots are underneath. And momentum is starting to slow down as well. We're going sideways in the short term. Then I have 3 intermediate term indicators. They're not negative yet, but they are rolling over. And we're still positive with our 2 long-term oscillators, but they're also starting to roll over as well. And then another momentum oscillators, the Copic curve, we're dropping below the red line, which is turning this negative. And we're still positive when we look at those stocks in the S&P above their 20-period moving averages, but we're declining. We're positive because we're still above 50. But when we go a little further out with the 50-day moving average, we're declining, but still above 50. We're declining below 50 when we look at the 100-period moving average study. We're still well above 50. We're at 59 right now, but we are declining with the 200-period moving average study. So taken together, this is more negative because we're seeing declines across these 4 different studies. And now this should be positive because we're at the upper end of the trend channel here, but this could be providing overhead resistance. And to this point, we have not been able to get above that. And the Nasdaq, it's positive. We still are in an uptrend here, but we closed a little bit below the 50 period moving average on Friday, where we did come down, but we're a little bit above the moving average with the Nasdaq 100. So there's some positive and some negative takeaway from these charts. The momentum for the Nasdaq 100 is pretty much flat. We were trying to improve. Now we're coming back down to the moving average. And so this is negative in that we're seeing a decrease in the positive momentum. Small caps just cannot get above their 50-day moving average. This is the S&P 600 small cap index. And we came back up to the 50-day moving average with the Russell 2000 small cap index, and now we're declining below that. And home construction versus 3 to 7 year bonds, this is continuing to show weakness after it had been trying to improve. This is something that we've been watching now for quite a while as interest rates have been going back up. And the semiconductor to Dow ratio, it's not really falling apart, but it's not really showing any strength right now, too. It's been kind of going lower over the last few months. So, what are the things that we're watching right now? We want to keep an eye on weekly jobless claims. They actually ticked up a bit in the latest reading. And we want to watch continuing claims, which continue to go up a little bit, which we had the employment situation report on Friday, and the unemployment rate actually came down to 4%. And we saw a lot fewer jobs created than what were expected. But then they revised the previous month's report, and it was a lot stronger. And it was strong even when we received it. So the market's a little bit confused like that. Are we seeing economic strength and the employment situation is holding up? Or are we seeing weakness like we saw a fewer jobs being created in the latest report? And then we kind of watch these that come out every week, the continuing claims and the initial claims, to see what is the overall trend here. The skew index, we've been up in this red area now for quite some time. We're just watching this to see if we something happens in the market to bring us back down out of this red area. This just means that the market is expecting some kind of a big move. And this is a variation of the VIX, where the VIX uses at the money options to be calculated. The skew index looks at out of the money options. And there's still a big move anticipated here that has not happened yet. And we're keeping an eye on especially the 10-year yield, where we have been coming down, but then we started to go back up. We're coming up to the 50-day moving average here. If these rates continue to go back up, that will be more negative. If we can stay under this 45 level, which is 4.5%, that would keep this a little bit more positive. And the reason why this is on the negative side, well, it's not. It's in the watching side here. But it had been more positive, and I actually could have put it on the positive side, but I didn't because we had an up day on Friday with interest rates. This is another thing that we're just watching is the interaction between cash, which is 1 to 3 month T-bills, and then 3 to 7 year bonds. When this is going up, that means that there's uncertainty about inflation and uncertainty about interest rates. And for the most part, this ratio has been going up. It was pulling back, which was more positive for the market, but then it's starting to turn back up. And we'll see if these inflation fears continue to go ahead in the market. And if that's true, then this ratio will likely continue to go up as well. Then we look at TIPS, which are Treasury inflation protected securities, and 3 to 7 year bonds. These are the TIPS adjust for inflation and interest rates mainly. That's what they focus on, are interest rates. And when folks are uncertain, they think interest rates are going to go up. They get into TIPS, where they think if interest rates have topped out and are going to start to come down, they get into 3 to 7 year bonds. Well, we're going up with this ratio, meaning TIPS are outperforming. Even though this ratio is in a downtrend, since the beginning of the year, we've been seeing this ratio really bouncing back up. And then we look a little further out, the same philosophy is applied here. When TIPS are outperforming, that means there's interest rate and inflation concerns. And that's what we're seeing right now when we compare it to 7 to 10 year bonds. And we want to keep an eye on the 10-year yield in Japan. That's what caused the problem last summer when we had the big down day and the VIX went to 65 and everybody was going crazy over that. Well, interest rates in Japan are continuing to go up. And at some point, is that going to come in and matter again to the markets? We just want to keep an eye on oil. Now, this has actually been going down. In a more inflationary environment, we would see oil going up. But we also watch this for geopolitical reasons, and this has been tapering off lately, getting into the low 70s. And this is the intraday chart that I've been watching for the 10-year yield. We've been above 4.5%. And this is right when Mexico said, okay, America, we'll play nice with you. We didn't stay there very long, and we ended up going back up after that. But then we saw a pretty significant down day here. And then finally on Thursday, we dropped below 4.5%. Now we're getting close to this again after Friday's session, but we're going to be watching this. This 4.5% level had been providing support. Now that we're below it, and if we start to go back up, is this going to provide resistance? And then we just want to keep an eye on the dollar. It's been pulling back, but it's still in a longer term uptrend. It's dealing with its 50-day moving average. The market's like a weaker dollar. If the dollar's going down, that will give support to stocks. So thank you. I really hope you found this helpful. Have a really good weekend, and I will talk to you in the next video.